Thank you for joining, everybody. My name is Ryan Gibson with Spartan Investment Group, and tonight we're going to cover the Growth Fund at Spartan Investment Group for 2023. And what the Growth Fund is going to tackle are things like ground-up developments, lease-up properties, and facilities that have the most value-add potential. So we have three funds, as everybody may know by now, three funds in 2023, the Debt, Growth, and Income Fund. And tonight, we're going to dive deep into the Growth Fund. We're going to go through actually 4 case studies of ground-up developments that we've done in the past, and we're going to tie it into how the Growth Fund is going to target investments just like that this year. So I'm really excited about this presentation tonight. I personally love new builds and ground-up development. I've been involved in development and really challenging entitlement projects with Spartan Investment Group for the past 7 or 8 years. It's how we got our start, how Scott and I did our first project together with Spartan in a ground-up development play. So really excited to reintroduce ground-up developments to our investors this year and have you participate and join. So with that, we're going to go ahead and get started. Thanks everybody for joining the Growth Fund webinar this evening. My name is Ryan Gibson with Spartan Investment Group. And before we get into the Growth Fund, first I wanted just to talk about the 3 funds that Spartan Investment Group has this year, the Debt, Income, and Growth Fund. And tonight we're talking about the Growth Fund. We're going to go into case studies, we're going to go into what the fund targets, where we invest, why Spartan has a strong team to do these types of projects, etc. But the first thing we'd like to do is get our disclaimers out of the way. We're not offering any legal or tax advice. This is just a general overview, so do your due diligence and consult with your legal and tax team on any investment decisions. These are just projections tonight. These aren't promises or guarantees. Everything is an estimate, projection, and again, a general overview. For complete offering documents and details, you can visit our investor dashboard, and we'll start populating all of the offering documents over the next couple of weeks. And with that, we'll go ahead and get right into it. So the Growth Fund is going to target projects that have ground-up development, value-add expansion opportunities, and facilities that have the most value potential. This might be buying an existing facility that has a lot of turnaround and no cash flow, but has a greater upside in it at the end. And also, I'd like to say that we're buying accretive and creative opportunities. And what I mean by that is we're going to find raw land and we're going to find deals that have a lot of equity that's made day one. Maybe finding property we're picking up for $1 million, that's worth $2 million on the day we close because of the positioning we can do with entitlements and things like that. So those are the types of things that the Growth Fund is targeting. It does not target cash flow. It targets most upside potential. So if you're looking for the cash flow fund, go back to the Income Fund. That's where investors can benefit from income, depreciation, and consistent monthly cash flow with the upside potential. So this one is just for highest absolute returns. So what we're targeting in this fund is an 18 to 26% annualized rate of return. And this means that our equity multiple is about 2 to 2.3x your money over a 5-year hold. That rolls up to about a 15 to 20% IRR. And again, the target hold period is about 5 years. 3 investor classes in the Growth Fund, just like the Income Fund, but with different waterfall preferences. Actually, this is probably our most favorable split that we've ever offered on any project in the history of our company. So I think you're really going to love how we've structured the different share classes for the Growth Fund. First of all, the class investors are broken out by investment minimums. So our minimums on every investment are $50,000. So a Class A member is an investor who invests between $50 and just shy of $1 million. A Class B member is an investor who invests $1 million to $2.99 million, and then a Class C investor is someone who invests $3 million or more. Alternatively, and as a bonus of investing in the first 45 days, you'll actually get moved up a full share class. So our funds are projected to launch in the beginning of March. If you invest within the first 45 days of the fund opening, you'll actually get moved up. So a Class A investor who invests $50 will become a Class B investor. A Class B investor who invests $1 million or more will become a Class C investor, and you'll get the benefits. And I'm going to describe what those benefits are and what impacts to returns you might have. And they're really significant impacts. So really appreciate those investors who invest a higher check size and those investors who commit to the fund early. So first of all, we have a liquidity preference in a growth fund, or in our growth fund. If you notice, it's not a preferred return, but 100% of the profits from the sale or liquidity go to the investors until they achieve a 12% annualized return. So if the project goes 2 years, or the fund goes 2 years, let's say, and we sell everything, the investors get a 24% return before a single penny is split with Spartan. So the liquidity preference is very strong. 100% of the profit, up to 12%, goes to the investors first. Then for the Class B and Class C investors, you can see we ratchet up that liquidity preference to a 14% and a 16% preference. And as you can see, it's very favorable. And then after that liquidity preference is met, we start the splits with Spartan Investment Group. Class A members get a very favorable 60-40 split after that 12% liquidity preference. Class B members get a favorable 65-35% split. And Class C investors get the best split of them all. After they achieve a 16% return, they still keep 70% of the money after that, and Spartan only splits 30%. That is one of the most favorable terms that I've seen in recent time, and I know that Spartan has ever put out. So what does this mean to you from a return perspective? Class A investors, we're going to just do a $100,000 investment comparison to every single share class. Even though I know that the minimums are $1 million for B, I wanted to show a comparable example so you can just see how the returns differ. So let's say you're a Class A member and you invest $100,000. You would expect in that range that we provided earlier to make about $214,000 over a 5-year hold. So you'd get your $100,000 back, and then you would earn about $114,000 in profit on top of that. That's a 114% return. Class B investors, better split, better liquidity preference, they're going to make more money. So they're going to get a 122% projected return over that same 5-year hold. So you can see the difference there. They're going to make 8% total return more from a projected standpoint than a Class A member would. So a pretty big bump to invest early. Class C investors have the most favorable splits of all. Likewise, their return projections go up to $229,000 for each 100,000 invested, and that is a 15% benefit over a Class A. Pretty substantial. And it's a 7% benefit over a Class B investor. So investing early pays, investing a larger check pays as well. And again, first 45 days, everybody gets moved up a share class, and those are the projected returns. So we've got a lot of questions so far on depreciation in the growth fund. Will the growth fund have depreciation? Will it be next year? Will it be in the year after? Here's the straight answer, and it depends, and we're not sure yet. So we don't want to come out and say you're going to get X percentage depreciation in the first year, because ground up development doesn't typically have depreciation until the year that the investment is entered into service. So let's say we buy some raw land and it takes us a few years or months to get that land entitled and then eventually built. We won't take that depreciation, which will be significant though, until the investment is entered into service. And that could be years later. So we do expect depreciation potentially in the future, but it's just not as clear and concise as, say, the income fund would be when we know we're buying assets that are entered into service on the day we buy and provide income and cash flow. So I talked to a couple of CPAs about this, and again, I'm not one, so please do your own due diligence. But they said, you know, an investor who's concerned about that should invest in both the income fund and in the growth fund. And what it will do, it'll counterbalance any gains that aren't offset with the income fund's depreciation. So if you missed the income fund webinar, I dive deep into this. I'm not going to go super deep on it, but if you had $100,000 invested in the income fund, that would get you a 30% tax loss. That's $30,000 per 100K invested. And even with the cash flow of $32,000, you're going to get depreciation in the first year. If you have gains in the growth fund, you can start doing some balancing of reducing your tax liability. So again, I talked about this a lot in the last webinar. I just wanted to introduce that as a potential strategy to go talk with your CPA about. So development value creation. The way to produce the highest value, the highest return in most real estate investments, but particularly self-storage, is to build from the ground up. And when you do that, you have to take the investment through many different parts of the life cycle, from finding raw land to building a building to leasing it up and entering it into service. At Spartan, we like to call it trees to keys. It's when we find a patch of land with a bunch of dirt and trees and we turn it into a big, beautiful facility that produces income. It's some of the most rewarding investing that you can do as a developer, and some of the highest value investing as well. So how do we develop value when we build from the ground up? I'm going to walk us through it. So our typical hold period is going to be 5 years in the growth fund. 4 to 6 years is our kind of our target window. In year one, we're going to go buy projects. We're going to go buy land. We already have multiple developments undergoing right now. Before the fund even launches, we already have 2 ground up projects and the high growth state that is Florida already underway. We'll talk about those later. So year one, we're going to find these investments, we're going to acquire them and start the entitlement process. Getting permits, getting approvals, working with local jurisdictions, doing a lot of work with our contractors to get these projects ready to build. Now, once you actually make those entitlements approved and get the project all set up, there's an opportunity to sell the land without putting a shovel in the ground. And I'm going to talk about a real-world example that Spartan experienced with this. That gives the growth fund an opportunity to exit. So let's just say we find a piece of dirt for $1 million. We put $500,000 paying consultants, going through all the process of maybe rezoning or entitling, etc. And once we're done, we go through all the heavy lifting. There are buyers out there that want to purchase that entitled land. They don't have the skill sets that we do, but they maybe know how to build storage. So they'll come in and they'll buy an entitled piece of property, and that gives us an opportunity for a quick win. We project a conservative 50% project return in the first year if we chose to sell land, and we would have this option to do this in the growth fund. Now, let's say we get all the entitlements done and we're ready to build these projects. Well, the second year is going to be dedicated to building the facility. We can build facilities between 40,000 and 80,000 square feet. It takes us about 1 year. And we have a few examples we're going to share tonight about how we did that. Now, once we build the facility, once it's open and we get what's called a certificate of occupancy, that's basically a permit to make money. So once you get the facility done and inspected and all the city officials come through and they say you can open for business and start collecting income, you get awarded what's called a certificate of occupancy, and now the facility gets more valuable. How much more valuable? Quite a bit. So we project the project to actually be at a 100% project level return in year 3 when we get an investment to certificate of occupancy. We have options here now. We can sell certificate of occupancy deals to REITs, we can to local operators. We can get the facility without any lease-up risk built and get it off our books and turn a nice profit in the growth fund. That's another strategy. The next strategy is we can just simply take the property through its lease-up. We have some examples of that tonight. If we take it through our lease-up, the property starts generating NOI, it starts getting customers, it becomes more valuable. Divided by the cap rate, that's how the facility will start being valued, or perhaps it would be valued on a per square foot basis. So once we get that facility partially stabilized, we project the project to turn 165% return. And then lastly, when we have the property stabilized, that's 85, 90% occupied, producing good income, we project an overall project level return for the fund of 200%. Really substantial. And of course, at that point, we can sell the facility. We can refinance out all that cash, send it back to you as the investors, starting with that liquidity preference, because again, a refinance would be a liquidity preference. That would mean that you would get 100% of those refinance proceeds until you achieve that either 12, 14, or 16% annualized return from that standpoint before any splits with the sponsor, with Spartan. So that's how you create value in development, and you can see across the top there's 4 key points within a development cycle where you have an exit option. So I would like to think that development has more options than in its life cycle than, say, an existing facility that's already kind of got the value squeezed out of it. So we're going to go through a real-world example here. This is land that we acquired, and entitled in Black Diamond, Washington, just south of Seattle. That's when we got the approval. There's us getting the construction phase started. And then there's the big, beautiful facility that got a certificate of occupancy. And then after we got the occupancy certificate, we started the lease-up phase, when we started hiring a manager, bringing in customers, and deploying our Free Up Storage national brand at the facility to start making it more valuable. And Free Up Storage is our national brand that runs our properties. So where is that investment in its life cycle today? Still in our portfolio. And what happened with that property, I'm going to follow the same timeline that I just shared before with some variations on what actually happened. First of all, it took us 2 years to entitle that investment because there was a lot of complicated issues creating more barriers to entry and higher rents for that market. So that was actually a good thing. It took us 2 years to acquire and develop. As soon as we entitled that investment, we had an appraisal for a significant more than what we paid and expensed for that property. And if we would have sold that property at its entitlement phase, the project would have earned an impressive 172% return. We actually had an offer on the facility or on the land at that point in time, but we saw a bigger value potential by building it. So huge opportunity here when we have the entitlements to sell it. In year 3, we started the construction. Took us about a year to build it. It's about a 90,000 square foot facility. And in year 4, we received our certificate of occupancy. We had an appraisal done on the facility. We had a broker opinion of value done on the facility. And based on the value that we had at that point, the project would have earned 113% return on investment if we had decided to go to market and sell it. Very good, very impressive return. And then now we're in the lease-up phase. We're leasing that property up very well, and we have an opportunity when it's stabilized to get to 175% total project return. And again, once we achieve the full occupancy at the property, a 350% return. So again, we're holding that in our portfolio. That investment was projected to go for 10 years because it was a little bit more difficult entitlement. So we're in a very healthy position. We're right about in year 5 in the lease-up. So that's a real-world example of kind of timelines. That's kind of represents the longer end of that 4 to 6 year hold and a type of investment that this fund would do. Now let's talk about another type of investment that the growth fund would do. This project is in Sandy, Oregon. It's a property that we acquired with permits in place and built these 4 really nice Class A buildings. You can see here, we built this building, and we bought this investment with permits mostly in place. We had to take it across the finish line, and then we went right to work on getting the property out of the ground. Now we're in the lease-up phase. It's a beautiful Class A facility, and this will be the only property that is built in that market for a very long time. That property, the previous developer had been working on permits for 4 years, 5 years, couldn't get it done, got tired, sold us the investment, and we were like, we looked at it and said, we've done way more complicated stuff than this. We got it across the finish line, and out of the ground we went, and we're already about 40% occupied, and we've been open for less than a year. So a lot of value has been created in that. So let's walk through that same timeline and talk about how value is created within that development. So year 1, we usually talk about, year 1 we're going to buy the land and then it's going to take us a year to entitle. Well, in this case, that year is skipped because we found this investment through our connections and through our good networking within the industry, and we got it with most of the entitlements already in place. So the first year was really skipped. Year 1 was all about acquiring and getting it out of the ground. And so now we're into year 2 where we've had a certificate of occupancy given to us, and now the facility has value because that facility is leasing up really quickly at really high rents, $25 rents, and we have an opportunity to sell it. Now, we haven't had a BOV, we haven't had any of that, so I'm just kind of following the timeline that we projected earlier, 100% return on investment. And in year 3, we're going to lease it up, again, increase its potential value. Following year 4, stabilizing it for the highest maximum potential. We could sell it anytime, we could take it all the way through its lease up, and we also have a refinance plan within the next year or 2 that's going to bring investor cash out, tax-free, and return our investors' capital. So again, that's the type of investment we would buy in the fund. The third investment is a facility or a project that we sold at certificate of occupancy. We sold it at certificate of occupancy in a record-breaking 22 months. We returned the investors a 65.45% IRR. Incredibly impressive. The investors made a 154% return on their money in 22 months. So development can be very lucrative. It also can be very risky. But this is how the development went. This was actually a manufactured housing community that we acquired that was partially entitled, 38 acres in Sequim, Washington. We started the construction phase. Took us about a year and maybe a year and a half to build it. You can see we did a lot of the plumbing and undergrounding utilities, got the roads in, built a really nice community, 217 homes, achieved the certificate of occupancy, and just prior to certificate of occupancy, we negotiated with a buyer who picked up the property. So we had about $13 million into the investment. We sold the investment for $25 million in 22 months. Really impressive return for our investors, and they were rewarded. So kind of following that same timeline that I presented before, we took about a year to acquire it, entitled. That property was partially entitled when we closed on it on February 14th of 2020, just prior to COVID. So we built that during the COVID-19 pandemic, believe it or not. And it took us about a year or so to build it, maybe a little bit longer. And then right when we got certificate of occupancy at month 22, we already had a signed contract, purchase and sales agreement. As soon as we got that certificate, the buyer had to close within 3 days of certificate of occupancy. Took all the lease-up risk off the table. So again, I didn't put the returns in here, but just to kind of follow along, the overall return in month 2022 was 154%. But normally we'd have a lease-up period and we'd have a stabilization period, and the investment would have gone on for 5 years. In this case, this was a 22-month deal. So the growth fund could have investments that we buy that get turned around that fast. Get the land, get it entitled, get it built, get it sold. Lock in that amazing return. So this is the type of deal that we would do, and you can see I've crossed out years 4 and 5 because we never even went through those years. We ended this 3 full years early. The next opportunity that I'm talking about is probably very familiar with. Existing facilities that have in-place revenue, about 735 units in this property, 81,000 square feet. And what's great is it came with 2 acres to expand. And what we did was we added on to those 2 acres, those 2 buildings. And what we did with this investment was we acquired it, we got the cash flow, then we got out there, got the permits about a year or so later, built the units, cut the ribbon here, and just started leasing them up. And we leased up the additional units that added millions of dollars of additional revenue, or additional value, I should say, to the property, and provided great results for our investors. So sometimes those facilities will cash flow, but not enough to produce consistent monthly cash flow. And when you consider we're going to be buying other deals that don't have cash flow in the growth fund, it's going to be difficult to project cash flow, which is why we say at the beginning, don't expect any cash flow in this fund. If you're looking for income replacement, the income fund is your best bet. The last big thing, or one of the big things that I want to talk about is just entitlement. This is a skill set that is very unique that our team possesses. And we can do things like we've rezoned property, we've gotten special use permit, we've moved wetlands. We've actually moved wetlands in the state of Washington working with the Muckleshoot tribes and the Department of Ecology and the Army Corps of Engineers. We've done numerous easements, probably over 24 easements in the course of our development course, and we've done pretty much anything that you can do in development, from building in our nation's capital, where it's extremely difficult to build in Washington, D.C., to building in areas that's got sensitive environmental protection, oversight, or local authorities that have a keen interest in seeing that development doesn't play out. So, and the way we do that is, we're typically very collaborative with the city, firm when we need to be, but collaborative in the way that we approach our communities, meet our neighbors, and really kind of work together to make these projects go. And these are just some of our pictures from over the years of submitting our hundreds and hundreds of pages of documents, going to community meetings, going in front of the planning board, going in front of the city council, meeting with the mayor, meeting with neighbors, et cetera, to get projects done. We do a lot of community outreach to make sure that our projects go through. And this is what we end up building. These are some really nice offices that we've built to give that really good retail experience to our new investors. This is why I really like building from the ground up, is you can start fresh, you can build exactly what you want to build, and really align that facility to the market. So now how do we do all this construction? Well, this gentleman here, Aaron Saunders, is our president of Spartan Construction Management. If you want to do your due diligence on our construction company, you can go to spartanbuilt.com. You can read all about our construction team. This is the Spartan construction team that builds all of our projects across the nation. We're building in 11 states. We've built thousands of units with Spartan Construction Management, and they have an excellent track record for building safely, building on budget, building on time, and really having quality controls that make our projects successful. Again, strong community involvement is really kind of one of our value-add strategies. A lot of these properties, we make sure that local officials get invited to them, like ribbon-cutting ceremonies or groundbreaking. We do a lot of groundbreaking where we have a golden shovel party, and we get everybody out there and break ground and really kind of celebrate that. And this builds community trust, and it also really plays favorable to leasing up the property faster. All of our properties have a brand standard that falls under our Free Up Storage National Brand Standard. You can see some of the examples here I have for pictures. We want good drive-by visibility. We want really nice monument signs or pole signs, whatever the local jurisdiction allows, to really drive traffic to the property. Everything we build is safe and secure. Customers want well-lit, well-fenced, security cameras. They want to know their stuff is safe. And this is a special emphasis that we put on all of our properties. Where do we put the gates? How do we secure the property? How can we get the gate as high as we can, conforming to code and conforming to insurance requirements, etc. So really important to have safe and secure facilities. We roll out ancillary revenues. I've spoke about this on previous webinars. We do U-Haul truck rentals, tenant insurance, retail sales. We offer a storage defender solution for those that want to monitor their facility or monitor their storage unit to see when doors open and close and temperature changes and things like that. And we do all this under the direction of Free Up Storage, our national brand. And our national brand, Free Up Storage, is our property management group that we control, that we started. And if you want to look at where all of our facilities are, you can go to freeupstorage.com, and that gives you our operating platform that we work with. We offer things like 24-hour bookings. We fully automate every property that we buy. We give enhanced staff training and ongoing training, revenue management, and we also provide a call center to make it easy for the customers to book. And we want to make it a frictionless process so that we can acquire as many customers as we can at the best rates possible. So that's a little bit about Free Up. Now, where are we going to build these facilities, or where do we build these facilities? Generally in markets that have high rent. And we're going to find these markets typically surrounding major population centers. So in this photo, I have the surrounding area around DFW, and you can see all the little red dots. That's where all our properties are today. Now, we don't operate in the core of Dallas or the core of Fort Worth necessarily. We're in the surrounding bedroom communities where there's strong population growth and where we don't have as much REIT competition or intense institutional competition that we would have in the downtown core. So we look for markets that have strong rent. We're looking for $20 rents typically where we're going to build from the ground up or greater. And we like high trafficked properties. We look at traffic counts. We do a full feasibility study for every investment that we buy. You can find our feasibility studies. They get populated in the deal rooms as we identify projects and finish those studies. You can read all about the age, population, growth, household income, drive-by traffic, unmet demand, etc. in a market. And we typically like to build these facilities around existing properties. So one of the facilities that we have under contract, or one of the land deals that we have under contract right now, is right down the road from our Ocala property in Florida. We like to have that economy of scale. And this provides payroll efficiency, market efficiency for advertising to our customers, and it drives down our NOI and cost. It increases our revenue, providing maximum benefit to our investors. And you can see on this map here, I've got little red clusters. Those are where our facilities are today, and you can see we like to co-locate within a certain market. We also like to invest where jobs are going. There's net positive migration of population, strong storage demand, rent growth and strong rents, income growth, and again, economies of scale with our existing facilities. So what is our exit strategy? I talked about entitling and selling. I've talked about entitling, building, and selling at certificate of occupancy. I've talked about kind of doing a partial lease up and selling or selling at stable. But our overall global strategy at Spartan for storage is having options. We don't want to say, oh, well, we just build and sell, or we just entitle and flip the land. Because what if you do that in a short suspense and you don't have a buyer, or the market for that type of product goes down? We want to have the full scale of options to take the investment to its maximum value and sell at the right time, right? And that optionality is really critical when making an investment decision. So I talked about this: sell to an entitled land to a developer, sell at certificate of occupancy, sell stabilized. But really, our strategy falls back on the fact that we have a huge portfolio. All the little white dots are all of our properties across the country. We have over 500 million in self-storage. We're the 40th largest operator of self-storage in the United States. And so we kind of view ourselves as that medium-sized fish in the industry. We're not quite the big boys, but we're not quite a mom and pop operator. We're right kind of in the middle. And what we do is we find those mom and pop operators or those one-off land deals that we can buy and really add a lot of value to. And as I said before, 39 larger operators than us, right? With more money, more check sizes. Just recently, the Prime Group announced a $2.5 billion self-storage fund, the largest self-storage fund ever put out there. Public Storage just announced a few weeks ago that they're going to buy, making an unsolicited offer for Life Storage for $11 billion. So the money in the space is really strong, especially in these uncertain times when storage has a tendency to do better. And they're not looking for mom and pops necessarily. They're looking for aggregated portfolios in certain markets. And that's where Spartan is a really nice fit for that exit strategy. Similarly, there's a lot of people that are getting into self-storage, a lot of mom and pops that might be in a certain market where they want another property where they're located, and our property might just be the one for them. So we're actually getting approached by a lot of individual operators as well. And the next slide I'll show is just how your investment works. So if you invest in the first 45 days, you get the benefit of a higher share class. That's the number one benefit to coming in earlier, because your return over the long haul is going to be considerably better than if you wait. So funds are accepted into the fund and deployed into the fund on a first-come, first-served basis, and 100% of your funds are due at the time that you commit. So we don't do capital calls or anything like that. Your full investment is due, and your funds benefit from all of the properties built and bought in the fund. You don't just go in on one or two properties. You are every deal that the growth fund buys. And then when we have liquidity events, or if we have any operating distributions, you start receiving distributions. We don't have an expected timeline. What we do is we are promoting this fund as an absolute highest potential yield fund. Every month you're still going to hear from us, though. We're going to send you pictures of our construction updates. We're going to send you monthly updates on the first. We're going to send you full monthly financials on the investments that we purchase. If there is a distribution, we send out our distributions on a monthly basis on the first of every month, and we deliver your K1s in March, which makes everybody happy to get their early returns done without an extension. And if you'd like to learn more about the funds, or if you want to join our wait list, you can use that QR code there on the screen. And also, you can go to our website, spartan-investors.com/2023-funds, and that'll give you the three funds. You can kind of click on each one, and you can get kind of an overview of those funds. And like I said earlier, we're going to have more information posted to the dashboard. And that is the growth fund, expected to open on March 1st. And I'm now going to kind of go into some frequently asked questions that we've had on the opportunity. So do I have to be accredited to invest? The answer is yes. The fund is only open to accredited investors. Do investors receive the benefit of bonus depreciation? The answer is kind of maybe. Bonus depreciation is going to be applied to any in-service assets that we build and get into service, and we will do a cost segregation whenever possible. Cost segregation study, bonus depreciation whenever possible. What kind of tax documentation do I receive? You get a K1 and they come out in the March timeframe. When do I start receiving distributions? I just don't plan on it for the growth fund. If you want distributions, the income fund is a great bet for that. We don't have projected distributions in the growth fund. And what is the anticipated cash flow? 0%. I just want to stress, I'm looking. This fund really calls for the investors that are looking for the highest potential return. And we just want to overemphasize that if you're trying to get to the destination of cash flow, this probably wouldn't be a good investment for you. Do you do capital calls? No, 100% of the capital is called at the time of the investment. And can I invest with my retirement account? Yes. Self-directed IRAs, solo 401ks, EQRPs, all those retirement accounts we accept. And how long will we be placing capital? First come, first serve. We've already, I think the soft commitments are well over $40 million for our funds this year. And this is a $45 million fund. So funds are accepted on a first come, first serve basis until we sell out all the shares and then we close the fund. Is there a redemption period? No, there's not. This is considered an illiquid investment. If you prefer an investment with a redemption period, check out our debt fund. That's going to offer a redemption period, but the growth fund does not offer redemption. And can I increase my commitment? So if you put in $50,000 and then maybe you have a liquidity event or something later on in your year, you have some more funds that you'd like to place. Many people did that last year. We do allow those additional investments to come in. However, it's based on availability. So if the fund already filled up, it may or may not be available. Check with one of our team members. And with that, I'm going to finish up today. Thank you for watching. And if you have any questions about the Growth Fund, you can email us at investors@spartan-investors.com. Thanks for watching, and we look forward to potentially partnering with you in the Growth Fund. Thank you.